trading intermediate term highs and lows. All right, in this chart here, you can see price is trading in a large consolidation. And the periods when the market is not trending one direction, they offer ideal conditions, for shorting above an old high and buying below an old low from a previous week or longer in time. So when we look at reference points in terms of classifying as intermediate term, it's beyond just yesterday, and it can be as short term as intra-week or previous month or 2 months ago. Old lows and old highs like that, they're gold mines, because think about who would be having their stop losses below or above those reference points. The whales, those large fund traders, when they have their orders in those markets, they're going to be placed around these higher time frame highs and lows. So if the market trades back to them, they're gunning those stops. Now, studying old highs and old lows and incorporating the PD array matrix, it's going to assist you in finding higher odds day trades. Now, the setups tend to present them more in terms of a dynamic response in price than that of just simply looking for what would be considered like an optimal trade entry or looking for a simple order block. Again, none of my concepts are panaceas, be all end all. They don't stand alone. They have to be blended with other things. So when you incorporate these setups with the PD array matrix and higher time frame institutional order flow, you're going to find dynamic reactions, and it's going to be always a bonus for you as a day trader, because we need movement. We need to have displacement. We need to see a rapid movement to get paid before the end of the day. So we're always battling time, and we're always battling the uncertainty of whether or not we're going to get magnitude of our move. So while most statistics state that day traders don't make money consistently over time, because they, number one, they don't look for the conditions that are ripe for day trading. This week we had some instances where in our live sessions we were able to call very precise what the market should be doing and where it should go next. There was other instances, once my objective for the week was met, you saw how I was off on my analysis, but I was not going into the marketplace and trading anymore. So that skill set comes by experience. You're not going to be able to do this just simply by taking these concepts and saying, okay, plug and play, I'm going to be good. It takes, a level of experience, doing it for a while, seeing it, and developing a feel for it. And that experience factor can't be communicated in a teaching. It has to be earned, and you have to do that through time. Now, when a market lacks directional trend and one-sidedness, those conditions, they offer more opportunities to trade like this than not. So when traders that identify range-bound conditions see that in their charts, once you do this several times in practice, once you see it in examples in the past, when you find yourself, on a Saturday morning, wake up before anybody else gets up in the house and sit down with a bunch of charts. Like I used to do this for years. Before I had children, I loved it. But not that I don't love my children, but I love the fact that I could spend my time doing that, and I would be uninterrupted. I wouldn't have any distractions, and I could literally pour over charts and really build scenarios of why price went up here. Who would they knock them? Why would they knock those individuals out? What was the purpose of going up there? Because when I first started trading, I thought that buyers just stopped running out of buyers, okay, and the market topped. And there's a lot of people still teach that premise in the marketplace. That's not what it is. The absence of the market makers selling it to them at a higher price, they don't offer it any higher. Because believe me, if they want to offer it at a higher price, all they do is offer the price, and they'll put whoever they want in that price, because a market order is a market order to get in right now. And they can couple that with a ridiculous price level that would be outside the normal range. Once I understood what price was actually doing and the behind the scenes view of what takes place for runs on liquidity, the concept of reversal trading was much more, in my opinion, my cup of tea. I liked it, which is the reason why my London Open strategy became like my repertoire for Forex, because essentially what you're doing is you're looking for reversal patterns every single London session, because the Judas swing, when we're looking for bearish moves, it's going to be rallying higher. what we're doing is trying to time that intraday reversal. So these reversal concepts are large in scale with intermediate-based ideas, that's what I'm describing here, but it also is minute to the point where we can reduce it to the London Open for Judas, the CME Open for the New York Judas, and Asia. It has its Judas at 8 o'clock, and then New York time, or 0 GMT. And then you have it also in London Close on days that create